Here we have MMTs, a standard public chart on Google. And what's nice about it is that we can see when Google tested that 200-week moving average over that last 4-week period that we have gone right back up to that key level area of resistance, and which we have. And that the 10-week moving average is pointing up as it is bullish as it is from a standard view with that weekly buy signal. And so at a 4.4 ratio MMT, that's the standard. Now, having said that, our SMF platform, which I'm going to pull up here in a moment on a weekly level, but first of all, this is a November $600 call, and this is a November $600 put. Okay? What we would like to know is why would the $600 call, naturally so up here, want to come back up toward these highs at 22.70? And on the flip side of it all is why the low of this contract was 682 right there on 1026 where my cursor is here now, MMTs. So why would this put option go back to what these lows were right here? So that was 682 on the call side low. We're 1450. Here is the call side value. Let me get it live right here. The high 3 days ago was 3250 on the put side. 3250 on the put side on what date? 1026. Today's date is 10/30 of 2011. On the flip side, 3 days ago, as we can clearly see here in the call, and it is a $600 call, and here's a level 2 bid and ask, 1570 on the high on Friday and a low of 1170. That was on this call, but 3 days ago you were at 682 on the low here on the call side. Naturally over here on the put side, $600 put, 3 days ago the put was 3250, and now the put has dropped in its value on 1028. The low of that same put is 1390 MMTs, and they closed at 1450 now with 842 on the volume side of things. So you can clearly see that when Google was breaking higher, of course the put options were losing their value. And when they're losing their value on this side of the market, they go up from the lows here, and the low again, MMT on the call side during that same time frame, that's 682, and the high, and remember the big gap that we had last week, and they pumped these to 1060. That means that there was a $10 yield from here to there, and now this very same call though is also losing value, MMT, because the low was 1170 for crying out loud, and the high was 1570, so the low was 1170. So that means that was $4 down to a wholesale entry here. They end up closing at 1440. So on 1028, when they hit that low at 1170, which was a good place to be buying the $600 call, is that was the wholesale price. They opened at 1170. Their high was 1570. If you're buying down here, you're doing okay because they closed at 1440. That's why the calls were working based on one major factor, and this is our platform, and it's our weekly platform. And what the MMTs clearly want to understand after reviewing the $600 call, the third calendar week expiration, that's 11/19, and the put is, why is the call going to go higher? And here's why the call is going to go higher. In our system, as the MMTs know that this is a weekly Google, and it's very serious because we are at very major diamond levels here, and these diamond levels back over here. Not only that, when you come straight across here, you're going to see a total congestion of diamonds right in here on 3-week breakouts. Look at here. You had shakedowns. That was the volatility right then. That was the breakout volatility to that high, and that counter trend reversal with upside weekly volatility. We were all involved. But now let's take a look at these major tops right here. Now if I'm going to break through this MMT, this is going to be the area. I'm at this diamond right here, and this diamond is neck and neck. We're going to have to trade up toward one full delta, which is $9.40. And if we go up one delta here, then that means only one thing, that the $600 call would go up in value. This was its original price area highs over here, and these highs were $22.70 now. So there still is a spread to come back up and test those prices, but in order for that to happen, MMT, I've got to tell you that we're going to have to, and it's a 5-day level, but you can see that we're closing up here at that high diamond in our system, in our market maker platform system. And that this diamond level right here that was on 8/1 of 2011, that very diamond level, half bar right there, you can see what it was at one time. But the thing about it is, these are the diamond levels that we have to clear right here on these highs. This is where that breakout was to the top. And so it's going to be this one here, this one here, and we're already above this one. And what we're going to do is at the previous week here, so let's take a look at all of this right here only in the platform. And basically what we're going to be doing here is that this is the focus right here. This is where we're at, and that's at 600 level. And if we're going to clear that 600 level, then we know what this is over here. We know that this has a representation back in a 5-day trading period when Google was selling off and you were closing below the diamonds. See, and then you had a narrow now look, this is the bottom here. But here's the problem, is I've got to close above these here, these upper ends. That means I need to go in price action one full delta here, $9.40. And it needs to be from the drop down entry or an opening gap and a run. It doesn't matter as long as it's $9.40. That's going to break through these diamond areas. We're going to go up and challenge these, and that would be one full. So Google has to travel up toward that 610 area, and once again it's using our weekly chart, because if that's going to happen, which it will, is you're going to have, so if you break through these diamonds, then that means that these calls go up toward $18 a contract. They're still not as high as $22.70 over here. That doesn't matter. What matters is where the yield is now and why that would go up $4 more. And most importantly is if I'm breaking through here, then these are going to go up in value automatically, and at the very same time, the very opposite trade is right here. Here it is. It's this one. The put option is going to go down in value toward down over here. You could lose another easily with that one scenario. MMT's breaking higher through those diamonds. Naturally, this put option is going to go down in value here. You know, here's the spread, MMT. Here's the spread right here. Here's the spread. The low was $13.90, so you know, and it's $18 there. So that put option is losing value against that call right now, where that call is stabilizing right here. That's the last high. So what? It's how we're going to challenge those highs. And not only that, why this value is going to go lower than $6 here. So they can potentially, in this contract, take out another $10 premium on that put side very easily. For the put side they can, but then on the other hand they could still premium over here and only give you, let's say they bring these up to $20, which they would, 18 to 20, we would be, you know, looking at it at the $18 level, because that's a $4 move. and then how the value is going to go down here. But then once again, MMTs, we do know one thing for sure is that the weekly SMF market maker platform right here is that these are going to be the diamond areas that we have to get above. Just like, look at that, and as long as on a weekly level that starts Monday morning and ends Friday at the close, as long as these things are elevated, we're going to have strong support on Google on the intraday drop down area, or when Google wants to pull back $3.50 or $4 intraday like it does. Those are great entries at that time. Great time to buy the calls and whatnot. What we're going to be looking for is clearly that if I break up here in my delta and I go up $9.40, I'm going to come over here and start challenging these mathematically here on that weekly level, and you'll be able to find that out because some of this we did yesterday. So if I go up a delta, that's going to be 608.19, and if I'm up two deltas at 1624, that's for tomorrow. So basically we're going to see if we can get above that one delta, which I just read it off. You can go find it, MMTs. That's about 606. So what would that do? Well, that would take the put down, and from a lower entry, this would go higher in value, MMT. So it's very, very careful that we watch it. That's the weekly level. This is the most important thing about this now. Okay, it's the SMF market maker platform. We own it. It's not like a standard public chart, but you do have the $600 call and the $600 put. Now, on the other hand, if things fell and we started to reverse to test support levels, these will go up. These will come down to the wholesale entry on the intraday level. So we would be a buyer. We can get it $2.50 below the market. We get hit, and then we keep it. And once we can get that wholesale entry on a drop down bid, that just depends on how things open tomorrow though for the call. And here's how the put's going to react. And they're both based on a daily chart. So you can see how values were made here and how values were lost here relative to our platform and how we use and how we make our decisions here, MMTs. The MMTs, you can see that blue line. We kept a standard technical analysis indicator on a market maker platform as a monitoring service. We don't make decisions based on it. Never have, never will. But you can see once that crosses over, that's going to pull these hedge fund managers in the equity. And there has to be where strength gets stronger and stronger. That's why Google is going to bounce on those lower levels. Every time it comes down and hits it, they're going to bounce strong off support. Why? Because there's a weekly buy signal in the standard public application, which is all factored in. What I do want you to know, that when it does cross over, it's even going to be stronger. Now, having said that, I can clearly show you the comparison. Once again, is that a Google weekly chart, which is a standard chart, compared to the SMF platform. So let's compare the two. This is a standard chart. This is the SMF market maker platform. And the diamonds have everything involved because it computes and operates totally different. This is a standard chart, which is totally different. But you can see that this line from a standard deviation public 100-week moving average is that when the green, this aqua blue line goes above the red one is a 20-week. That's all standard stuff now. This platform is different. And it has it mathematically figured what all they're going to do. So as far as price action movement goes. So when you do get that crossover up, the public is going to say, hey, let me get in. Things are extremely strong. Now, our platform versus this one is you have that weekly MACD buy signal. And we already know, MMTs, that you haven't had a buy signal. And we already did the math that this weekly buy signal is much stronger than these last 3-week buy signals, which was part of that 3-week breakout. And it's the beginning of a new one. And if this gets stronger, then you're going to get above these diamond areas, and we're going to see if we work our way right back up to the top here. That's going to be the top of that diamond. That's that top resistance level. Okay, the second resistance level is going to be in the short term right here. Okay, it's going to be in that diamond in this one. And currently, going straight across here is closing above this diamond here, and having delta expansion will also populate and that's how our platform reads. Over here on the standard one, this will happen, and that will pull the bull off the sideline, because this is all they have to make decisions on. So we understand that, and the platform already has that. So that's going to take this call option right here. That's going to take this $600 call option right here. Yeah, it is. Against this, against what? Against this right here. $600 put. Here, you have a $600 put. They're 1410 by 1450. 18 was the high. 1390 was the last intraday trade. Okay, they ended up negative. So what ended up happening is, when that was making the peak, that was making the low at 1170. And then you can see the high was 1570. They're 1430 by 50. This is 1119, by the way. So let's pull this in here so you can see them. That's 1119. Yes, it is. Yes, that it is. And that is wholesale. That is the close. Now, that put side, as you know, is that put chart that we have. And that's this one right here. Here's a call. And here's that put. That put's going to go down in value and can take $10 premium out of here, and you can get a $7 yield there. And it's all going to be based on the fact that Google can do this here. And what Google has to do in our market maker platform is that it has to have a 2 delta expansion through these resistant areas. And that would equal, from low to high or whatever, 2 of these is going to be $18.80 now in a teeny value, which is a delta value. $9, you need 2 of those going through this area. Bottom line. And what we would like to see when there's really strength and there's really hardcore breakouts is that you're going to break out through that first delta, and you're going to break with another delta. So you're going to have 2 delta up expansion. That would put you 2 deltas. That puts you right here, right at the tops. And so basically, as we move through the next 5 calendar days, today's date is 9:01 a.m. Pacific Standard Time, 10:30 of 2011 now. So we know that it's 9:01 a.m. Pacific Standard Time on a Sunday. We do know that the date is 10:30 of 2011, and we do know why the put would go down, and we do know why the call would go up. And here's the call, the lower one. And why can this continue to go down in value here and this to rise in value there would be that we would break higher. These would go down and these would go up. So you get wholesale here, and each day we have to get the entries though in these right here. These entries both, so you can only do one at a time. So if you get wholesale here, and when these go way down in value, you can go up and you get really wholesale. Let's say you get wholesale, at some point $6 below here, and you're in, and these are, let's say $4 up in value, so that these were where the put was. It was at 18, but how do I get in here? Let's say I get hit at 13.20, and they come back up on the call side here to 18 where they were on the put side here. Then I understand why that the price action has to have a 2 delta expansion. And once again, MMTs, just for your well-being, is that the most beautiful thing is that this here will take out these diamond highs, and that the high up there is 624, and each support level or each drop down bid or pullback intraday is to buy the call and sell it back to the public, and or get that wholesale bid and hold it as it does break through it, because the value will continue to stay higher. And taking the $4 spread out of the short-term contract on 10 contracts, well, that's a $4,000 trade here. And over here, when this drops down to, let's say, $9 or $8, and we'll see what the weighting part of both premiums are relative to that strong breakout here, and we will put the trades on. It's to buy the dip over here, and we will see that if there is failure, what would we do is, well, we'd have to come back here and close below this diamond. So 2 deltas down is support, and 2 deltas up is resistance right here. And we will trade the put and the call. Once again, MMTs, it's about buying wholesale over here. And when we break through, we hold the call contract because we're going to get a lot more value. This was 18. They brought it down almost, well, they did. They brought it down $4 on the put side. And they took it from 11.70, and there was $4 here on the call side. So basically, we want to be buying these at support level with our entries and then selling the rip and having a good time. This is a special preview on a $600 call versus a $600 put with the SMF platform. It's all here. It's all now. Tomorrow will be Monday morning, and it will be Halloween. Happy Halloween to everyone. And we're going to see where that buyer wants to step in the first part of November. Hey, they'll show up on that 3-minute, 15-minute, 60-minute chart, my friends. And once again, the reason why we do this live the previous day before we start making markets, we already own other calls. But the thing of it is, the people that own the calls for tomorrow morning, if we get a gap up in the futures, we would be selling those and getting on these Novembers now. So yeah, we would be watching a weekly, but the 11.19, that's the monthly. So you know it's a monthly, 11.19, $600 call, $600 put at higher highs, and you need to have a 2 delta expansion to take these contracts back up toward the neighborhood of 1950 by 2150 on the bid and ask on a $2 range. Right now they're viable down here, and these would have to fall in value. MMT. That's how markets are made. Once again, call side, $600 call chart. Once again, that's where the put contract was at 32.50 down here. They've already taken a lot of premium from that side. This side here, 682. Hey, that was over 100% move. What can I say? They got room to move higher when we break through resistance on Google.